Let's get to roles and responsibilities of the investor-owned utilities,
Yes.
how they play in
Oh,
this very
yes.
complex
They're
plan.
private for-profit businesses,
Right?
but they're different because they're regulated. That makes them different because A, they can't set their price
Mm-hmm.
because they're not subject to competition. The state gives them a service territory and says, you're the only one that can sell this product, but the state takes from them the right to set the price. The other thing the state takes from them is the right to dispose of the assets or to sell them to somebody else. So the assets, whether they're highly valued, whether they're selling it below market, or whether they're above market, are basically held in some ways analogous to trust for the ratepayers. The utility is paid cost of service rate making, whatever it costs to produce them, and then the
Plus their
benefits.
fixed rate of return.
Yeah.
Which is
part
what,
of the
Ted?
cost of service rate
Right.
making.
But what would we say the average cost of return rate for a
Is 6 or
asset?
7%.
Mm-hmm.
Now, when you see, if you Google ROE, which is the return on equity, you'll get a higher number than that.
Yeah.
But the equity is part of how they're financed. The other is debt.
Mm-hmm.
So when you take you take the asset base, we'll call that $100, and you say we're going to do $50 debt and $50 equity, that ROE only applies to $50.
Right.
Then the debt, which is usually actual market debt based on bond issuance, is the other 50. And then you take them together and do a weighted average, and that's called the weighted average cost of capital. And that's that with, well, and all of this is very interest rate sensitive, so I'm probably going to be dated on some of my numbers. I'm guessing that's 6 or 7 right now, and this time last year might be like 5.8, 5.9 to 6.25. So then you add 2 or 3 points of interest that goes up, and of course that will trickle through to the customers. Well, that's enough.
Which they call ratepayers, but let's
Yes.
not be. Yeah. So their obligation is to provide energy services to retail customers.
Yes.
Right.
And they have the universal service on the electric side. They
Right.
have a universal service obligation,
Mm-hmm.
which that's another problem with customers leaving, because when you have a universal service obligation and you have different population densities, inevitably it's more expensive to serve in lower population density areas. And so the IOU carries that obligation they have to serve. So if somebody comes in and cherry picks a concentrated thing that's easy to serve because there's less wires per customer, and all of this played out in the 60s with telecom, with the AT&T monopoly. So there's a lot of stuff you can look at and learn from all of that. So they have an obligation to serve, which is part of their monopoly construct, but then they're for-profit entities. They have an obligation to their shareholders.
Right.
But part of what makes the system work reasonably well or over time is these are granny stocks, which is a good thing. They're low risk, stable, because the risk, and this is a highly risky business, whether it's good or bad, flows to the ratepayers. And the reason it's that way is to keep them as granny stocks.
Well,
so they're low risk,
having
low
PG&E,
return.
but having PG&E in bankruptcy for the second time in 20 years is
Yes.
really not a granny stock. No one would call it
Yes.
that, I don't think.
Yes, and yeah, that's an important regional difference. Now, the wildfire liability, there's some of the liability rules that contributed to that.
Yes.
And also the switch to markets contributed to that, because when they first switched to markets, they deregulated wholesale prices and they left retail prices regulated.
Yeah.
So if
that was at the turn of the century.
Yeah.
Yeah.
So if 2 years ago, you would have regulated hamburger prices at retail, but not at wholesale, who's ever paying the inflation on wholesale that can't pass it to retail, they go straight to bankruptcy court.
Underwater.
And that happened in California, that happened in Maryland. And it was because there was you can't deregulate wholesale. And if wholesale is the contributor to retail, leave retail regulated without creating the risk of that kind of a major screw up.
Yep. Yeah, definitely.